we've been talking about the possibility of recession for what's felt like, a very, very long time.
Yes, so far economists have been talking about the coming recession for a really long time now, but apparently the recession could now be canceled.
Wall Street remains braced for a recession, eventually. That's in part because consumers are poised to slow down their spending.
So here's why this is really important. Consumer spending makes up roughly 70% of the entire US economy, and it's now slowing down, which means there should be a recession, but this time it could actually be different.
I continue to think that it's possible that this time is really different, and the reason is there's just so much excess demand, really, in the labor market.
I mean, it's been amazing how resilient, in a way, the consumer has been to this inflationary shock.
Okay, so consumers are still resilient because we still have to spend money on the essentials regardless of how inflation has made them more expensive. We still have to pay for rent, for food, gas, and electricity, and because consumers are still spending money is why the global economy is not yet in a recession, because it's being propped up by us, the consumers.
The reality is that as prices are rising, the things that you have to pay for, the everyday expenses, your rent, your mortgage, your utilities, food, all of that is increasing, and increasing dramatically in some cases.
So right now we have a very split economy, and people are arguing whether US consumers will slow their spending down enough to cause a recession. Now on one side, some economists are arguing there's enough of a savings buffer to shield people from all the price increases, which shouldn't cause a recession.
Consumers still have the financial buffer. Even when spending is slowing, the process might be gradual because they still have money in their bank accounts.
Other economists argue that our GDP, the gross domestic product, in other words, the value of all the stuff the country makes, was just too low in Q1 of this year for comfort, and that in the next quarter, we could get a negative one. And remember, a recession is two negative GDP reportings back to back.
At the end of 2023's first quarter, gross domestic product grew at 1.1%. While not negative, this growth isn't strong enough to rule out the possibility of a recession. Something is occurring underneath the hood here. People are shifting what they buy.
That's right, there's a shift happening for how we as consumers are spending our money. And the question is, if we slow our spending down enough to cause that recession, what will happen to not only consumers but also the investors? Will the Federal Reserve step in by lowering interest rates to get us out of the recession, or will they leave the interest rates where they are today at 5% to continue to fight the inflation?
The strong consumer spending may be keeping inflation hot. In March 2021, the headline inflation rate shot past the Federal Reserve's target of 2%. Fast forward to April 2023, and inflation remained close to 5% annually. The escalating prices are only just beginning to slow people down.
So in today's video, I want to share with you some of the latest information and some of the latest data that's happening to the economy and this whole recession conversation, so let's get into it. Hi, my name is Andrei Jikh. Hope you're doing well. Cover the finance and stay for the Tetris. Oh, the things I do for you to smash the like button. All right, in all seriousness, so far we've established that looking at consumer spending is one of the most important things when trying to figure out if we're gonna be in a recession.
If consumer spending is strong, that alone is, generally speaking, enough to keep the economy from slipping into a recession.
If consumers are spending money, we can avoid a recession. If consumers stop spending money, then a recession's almost inevitable. But the thing about consumer spending is that it's dictated by two very important things: access to debt and incomes. Now, anyone has access to debt, but technically, because interest rates are still really high, between 5 and 5.25%, access to cheap debt is not actually here, so that decreases consumer spending. The second thing are, of course, incomes. Now, according to the latest data from the Bureau of Labor Statistics, the real income as measured against inflation is up 0.1% ever so slightly month to month, but the real income is down 0.5% when compared from April last year to April this year. Now, when incomes go down, people become more budget conscious.
In a February 2023 survey, 4 out of 5 consumers said they were tightening budgets by buying less in bulk or shopping around more often for better deals. These sorts of micro decisions have a huge influence on the pace of economic growth.
I'm feeling it when it comes to food, which is so weird for me because I've never really concerned myself with how much food costs.
And when people start to feel the price of basic necessities like food go up, interesting things start to happen with their savings. Check this out. This graph shows American consumer savings. Now, the red line represents the trend of where savings are, but the blue line represents their actual savings. And you can see that at the height of the pandemic, savings went up to a peak of roughly 33% thanks to all the stimulus. But after Q4 of 2021, savings started to go down below the red trend line. And in Q2 of 2022, the savings rate reached the lowest point. And all of that happened to perfectly coincide with inflation. That's exactly when it reached its peak of 9% in June of 2022. But now that inflation is coming down, we can see that the savings rate is slowly starting to come back up. But there's a huge catch. That's a huge catch. The card and fan. You know how hard this is? I'm an idiot, I'm sorry. The huge catch is that the data is actually showing people of higher disposable incomes, but people with lower disposable incomes are being affected the most, and that's why they're tapping into the forbidden shadow realm of credit card debt.
Economists believe that people with less money may turn to credit to cover expenses in this economy.
I think it's really scary how much people are using credit to be able to afford what they need to have every day.
That sentiment shows up in this data set from the Bank of America Institute.
And you can see from this data that people making $50,000 or less are utilizing the most amount in credit card debt. And this is really important to look at because it helps us better understand how this consumer spending is being funded. And that will help us better understand how bad the recession could get for the average consumer. Because are people spending money they already have from their savings accounts, or are they borrowing money to do it? During the pandemic, for example, people didn't need to borrow money because they were getting help from the government with all the stimulus. But now that the stimulus is gone, data shows people started to borrow more.
But that trend is starting to reverse. At the end of 2022, the average household had nearly $10,000 in credit card debt. Analysts believe that nationwide credit card debt may soon reach $1 trillion, an all-time high.
Putting everyday expenses on credit is so very dangerous because we know that as interest rates have been rising, so have rates on credit cards. So is the interest that you're paying on that money that you are indeed borrowing to pay for everyday expenses.
That's right, and now is arguably the worst time to borrow on credit to buy your essentials, especially if you carry a balance when interest rates have reached an all-time high of 20%.
Credit card interest rates have never been higher, topping 20% nationwide in February. These interest rates move up and down depending on the central bank's federal funds rate. And these rates are generally only charged to customers who carry a monthly balance.
By the way, that part of CNBC's video is sort of inaccurate, so side tangent here, it's kind of important. Remember, the Federal Reserve does not set credit card interest rates based on the federal funds rate. It kind of does, but it kind of doesn't. The federal funds rate is the rate for banks to borrow money from each other. That is not the rate we as consumers get to borrow our money for. Instead, we get what's called the prime rate, which is usually 3% on top of whatever the federal funds rate is. So for example, right now the federal funds rate is between 5 to 5.25%, somewhere within that range. So for us to borrow money, we would have to pay closer to 8%. That's the prime rate. Now the prime rate is set based on the average across the banking sector of what they charge their best and most qualified borrowers to borrow money for. In other words, 5 plus 3%, 8% for us. Now hold on a minute, Andrei. Why then, if prime rates are closer to 8%, why are credit cards charging us above 20%? That's a thick markup. And that's because credit card debt also has the thickest form of default. Meaning, you are far more likely as a consumer to walk away from your credit card debt far before you walk away from your car or your house. And that's why reason number 2, credit card debt is non-collateralized. Meaning, if you stop paying for your credit cards, banks don't get to have their money back. All they get to do is ruin our credit score for 7 years, but that's about it. That's why when you go to borrow money to buy actual collateral that can be repossessed, like a car or a house, that's when we get those rates that are far closer to that prime rate, which today is 8%. But that's where it starts. So your prime rib roast rate starts at 8%, but if you have anything negative on your credit score, that's when it starts to go up above 8%. Anyway, side tangent here, but that took me a while to understand. But overall, the prevalent theory is that we'll most likely get a recession in the second half of this year, and the warning signs are practically everywhere.
Other parts of the economy are flashing warning signs too.
There's been a lot of speculation since the recent failures of a couple of large banks. This could spark a reduction in in credit.
You know, banks are becoming much more nervous. They've seen a bit of deposit flight in some of these small and regional banks. This combination of higher borrowing costs and reduced access to credit, this double pincer movement, if you like, on the household and the corporate sector of America is, I think, what could be really, really concerning and damaging for the growth prospects.
And that's exactly why Fannie Mae just put out their thoughts this last weekend over the recession and what they predict, which is that a recession is also extremely likely in the second half of this year thanks to credit tightening. Remember all those failing regional banks we've talked about? Well, that's what happens when you party too hard at EDC and then the gravy train stops from Papa Powell, and now the banks that are left are like, maybe I shouldn't party too hard so that I don't end up like my friends. That's when they tighten their lending standards, they stop lending as much money, that's what translates to lower consumer spending, which translates to a lower GDP, which eventually translates to a recession. Now, so far throughout this video, there was a lot of data that shows why a recession will most likely happen, but there are a couple reasons why it might not. And reason number one is because the labor market is still extremely strong.
I think it's unlikely that we're currently in a recession. And probably the biggest reason for that is that the labor market is as strong as it is.
But arguably the bigger reason why a recession might not even happen is actually pretty surprising. It's housing.
In the US, home prices have risen nationwide by more than 30% since 2020. Roughly 2/3 of US households own a home. Economists believe that these house price increases can amplify spending.
If you do in fact have equity in your home, you may potentially be in the market for a home equity line of credit. This is the ability to borrow against your home value.
Exactly. Because home values went up as much as they did during the pandemic meant people built up a ton of equity, which also meant they could borrow against their house with something like a home equity line of credit to fuel that consumer spending that's so important that we've talked about. Of course, doing that is extremely risky because interest rates are still in motion. They're in flux. And that's why, ultimately, it all comes down to this.
The Federal Reserve, for now, says those interest rates will stay higher for longer.
With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation.
So here's the ultimate truth about inflation that the internet and people in general don't seem to understand. Prices are not coming down. Yes, inflation is absolutely coming down, but prices will not be. And remember, that's because inflation is just the measure of growth. So when inflation goes down, it just means the rate at which prices are growing is slowing down. But prices are still technically going up, just at a slower rate. And that's why people never agree with each other over what is happening with inflation and the economy, because they misunderstand what inflation actually is supposed to represent. That just means that inflation will continue to put a strain on people's savings, their credit card debt, and the people that it'll hurt the most are those without an emergency fund and people without a cash cushion. And that ultimately leads us to the ultimate question of what will Papa Jerome Powell do? Will he get us out of that future recession by lowering interest rates, or will he keep those interest rates high to try to get rid of the inflation, aka slow down the rate of price expansion? Now, the stock market thinks he'll start lowering interest rates as early as November. And believe it or not, data actually kind of supports that conclusion. Dating back to the 1950s, the average amount of time the Federal Reserve started to cut rates after their final rate increase was only just 2 months. Now, we've already seen our last interest rate increase in May of this year, so sometime later this year, we might see interest rates go down. The Fed is telling us that won't happen, but data shows that it actually might. Now, if you're in the market to buy something, you might get an opportunity to get that lower rate later this year. Personally, I don't try to time the market, which is why I always dollar cost average into it, but at least I do try to understand it. Now, I'd personally love to hear your thoughts about this because in my opinion, the recession is not canceled yet. In the meantime, focus on your own investment journey. I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks. Links are down below. Go track them automatically with the spreadsheet link down below in my Patreon. Love you. Thank you so much for watching this video. I'd love to see you back here on Monday, Friday, sometimes a Wednesday. See you soon. Bye-bye.